So Erik's going to be presenting Urban Catalyst, as he always does, the founder and CEO of Urban Catalyst. They've been one of our longtime partners on our Opportunity Zones platform. They have one of the most successful Opportunity Zone funds in the country, doing development deals in San Jose, California. Today, something a little bit different from them. It's a non-OZ fund. They call it the Urban Catalyst Multifamily Equity Fund. Something a little bit different this morning, the Multifamily Equity Fund. Is that right?
That's right. This fund is, unique to us as it does have other, positive tax benefits different than the Opportunity Zone Fund, but it's still centered around ground-up development in San Jose, which is kind of our bread and butter.
All right. Well, without further ado, feel free to dive in when you're ready.
Again, thank you, Jimmy, for having me on, and also thank you to everyone for your interest in Urban Catalyst and its UC Multifamily Equity Fund 1. We call this UCME. So this fund is structured a lot like a traditional real estate equity fund. We're focused on doing a ground-up development project. We're building an apartment building in downtown San Jose, California. We also accept qualified funds, which means we accept retirement funds in this fund. So that means IRAs are eligible for investment. And we'll talk about some of the tax advantages if you choose to invest an IRA into a fund like this. Obviously, we have disclosures and risk factors like all of our funds. But just to kick us off, we've been featured pretty prominently in the news here in downtown San Jose over the last few years. As Jimmy mentioned, we have several Opportunity Zone funds here in downtown. We have lots of ground-up development projects, really just, a lot of positive buzz about what we've been up to. And for this fund, what I'm going to do is I'm going to dive right in to this concept of investing an IRA into a ground-up real estate development fund, and what happens if during the timeline of our fund you convert an IRA to a Roth IRA. So just a little bit of background. Obviously an IRA is a retirement fund, and the way that it works, of course, is when you invest into an IRA, you don't have to pay taxes. So you don't pay taxes. You put the money into the IRA. It grows, throughout the course of your life, and then when you retire and you pull the money out, you have to pay taxes at that time. Roth IRA is a little bit different. You do have to pay taxes up front when you put the money in, but then it grows tax-free throughout your entire lifetime. So a lot of folks do prefer Roth IRAs to IRAs because of that tax-free growth. Now, if you've already invested into an IRA and you want to do a conversion to a Roth, there's a problem. And the problem is when you do the conversion, you have to pay taxes. So this is just an example of how much of your portfolio could be taken away if you do an IRA to Roth IRA conversion, which, some people still do them, but they're call it less common than they probably should be because of this issue. But the good news is there's a solution. The solution is investing into ground-up real estate development funds like ours. Main reason for this solution is while our project is under construction, we have a reduced valuation. When we get to that reduced valuation, folks can choose to do an IRA to Roth IRA conversion. And when that happens, it's a lower valuation. So let me kind of explain how it works. So step one, you invest your IRA into a fund like ours. Step two, we start construction on our projects. Our net asset value goes down. When that happens, step three, we send out notification to all of our investors and to the custodians who manage the IRAs that we have now reached this lower valuation. Step four, investors get that notice. They do the conversion from the IRA to the Roth at that lower valuation. And then step five, it's very typical for ground-up development projects that when we build the buildings, kind of the reason why we do development in the first place is when we sell the buildings, we anticipate that the buildings are worth more, built, stabilized, fully leased up than they cost to build. So we should have a higher valuation at exit. That's kind of the whole point of development. That's how it works. Now, I do get a lot of questions about, well, how does this decreased valuation occur? And we've been explaining this for all of our Opportunity Zone funds and really for all the ground-up development funds we've had because this happens every time because it's just inherent to ground-up real estate development funds. The good news for this fund, of course, is that we've structured it intentionally to accept retirement accounts. so that folks could do this IRA to Roth IRA conversion if they choose. But here's an example of how it works. By the way, this is not a representation of our fund. This is just an educational example. If folks invested $1, we would anticipate by the time we start construction that we're going to have a devaluation, of 30%. It could be higher than 30%, but 30% is a pretty conservative estimate. The reason for that devaluation is really a couple of things. The first is investors that are investing into our fund are limited partners. They have minority interests. That also means they have a lack of control. They can't do things like force a sale because they are limited partners. And then the last thing is really this lack of marketability. The lack of marketability, you can imagine if we went out to sell a project that's under construction, how much more challenging that sale would be. I mean, we have construction loans, contracts with general contractors and subcontractors, a lot of issues with the title companies, broken priority, all of those things. And what that does is it creates more risk associated with the transaction that lowers the value of the project while it's under construction. So we do anticipate having this lower value throughout the entire duration of construction. Once we complete construction and we start our lease up, we anticipate the value to go back up again. That's kind of how the J-curve works. Another example, and this is kind of more of a direct example of how investment would work, but again, this is not a representation of our fund. If you invested $1, we start construction, that dollar is now worth 70 cents. You do the conversion from your IRA to your Roth. You have to pay taxes, and you're paying 28 cents in taxes. If you remember in the previous example, you had to pay 40 cents in taxes, so you get this reduced amount of taxes owed. Just to, as a reminder, I mean, of course, you invested $1, and then you had to pay 28 cents in taxes. But if $1 grew with, say, an assumption of an annual 10% growth over 4 years, it's worth $1.46. And you can see this is more than your investment plus what you paid in taxes. And it's about a 5-year fund. So that's how that works. Some details about our fund. It's a $67 million offering. Our minimum investment size is $50,000. We do have this 3 to 5 year time horizon, probably closer to 5 years. Our location is San Jose, California, downtown San Jose, and we do have a multifamily apartment building. A couple of things I just like to go over with all of our potential investors is, our fund, as I mentioned, is structured just like a traditional real estate equity fund. And we do accept retirement accounts. But we don't do anything associated with your IRA or your Roth IRA or the conversion. That's really up to you as the investor. We just want to make sure that anyone who chooses to invest with us understands that aspect of our fund so that they know they have a lot of responsibilities in this fund to understand, for example, who is their custodian, how do they have a self-directed IRA? If they do invest, how do they do the conversion from an IRA to a Roth IRA? We want everyone to come into our investment with their eyes wide open. I want to talk a little bit about the downtown San Jose market because that is where our asset is located. And of course, real estate does really matter when it comes to these funds. This is the current skyline of downtown San Jose. And really, we like this before and after slide because it really shows the massive revitalization that's happening here in downtown. If all of the projects that are either under construction or are in the planning process or built out, say over the next 10 years or so, downtown San Jose should almost triple in size. And you can see Urban Catalyst, our Opportunity Zone Fund projects, and this project there in red. Downtown San Jose really has everything that we want to see when we do development anywhere. Here at Urban Catalyst, we've been developers doing business in the Bay Area, Silicon Valley, and downtown San Jose for many years. But downtown San Jose is especially attracted to us, because it hits all these criteria, including, we want to make sure that there's demand for all the different types of projects that we're building. That demand here is really generated by the Silicon Valley job engine. We want transit and physical infrastructure to already be in place. Downtown San Jose is really the only true urban environment in Silicon Valley. Diridon Station is slated to be the largest train station on the West Coast. Already has a variety of mass transit options that connect to it, including Caltrain, which gets you to and from San Francisco in about an hour. And now BART, which is the largest mass transportation system here in the Bay Area, is fully funded to connect through downtown San Jose into Diridon Station. And then San Jose State University, it's right in the heart of downtown. It's the second largest university in the Bay Area behind Cal Berkeley, with a little over 35,000 undergraduate students. And then last but not least, we want to do business in a place where the local government wants to see development happen. And that is not the case in most California cities. Most cities are somewhat anti-development, but here in downtown San Jose, they want to see development happen. And a lot of that's because of our current mayor, Matt Mahan. This is a picture of my partner, Josh, and I with Matt at one of our groundbreakings. Some of the policies he's put into place have really streamlined the pre-construction process and made downtown San Jose very developer friendly. To continue talking about downtown, sometimes it's easier to look at a two-dimensional map. So this black line, this represents downtown San Jose. Our project that we're focused on for this fund is our apartment building located right here. And we'll go into some more details about our project specifically, but here's its location. Our headquarters here at Urban Catalyst is right here in downtown. We're right next to Adobe's world headquarters and Zoom's world headquarters. It's actually been really fun. Adobe's been building their 4th high-rise tower here in downtown. It's a 1.3 million square foot office building, and they just completed it at the end of last year and moved 3,000 employees in January. So that's been pretty fun to watch them do that. Also, you've probably read in the news that Zoom is now back in the office, and why that matters to us is because we share a parking garage with Zoom, and now all of my employees are complaining that there's nowhere to park. San Jose State University right here. This red dash line is the new BART line that's running through San Jose with a station here in downtown and then connecting into Diridon Station, this big train station. Now, really the biggest story over the last few years here in downtown has been Google and just their massive acquisitions. And I'll go into a little bit of detail about that. Google over the past 5 years has acquired 80 acres of property. They've spent more than $500 million on these acquisitions. Their plans that they had approved show them building roughly 7 million square feet of office and 6,000 residential units. Build out, this will be Google's largest campus on earth. This will also be Google's 3rd campus in the Bay Area. There are other 2 campuses in Mountain View and in Sunnyvale. They're just about done with their Sunnyvale campus, just a couple buildings left to build. They did start construction, some of their preliminary work on this campus at the end of last year. Google says this campus is a 10+ year, $19 billion build out. So it'll definitely be a nice shot in the arm for downtown San Jose. I mean, who acquires 80 acres of property in the core of a downtown city? So it's pretty neat stuff. And of course, our project here is 500 yards away from Google's first phase of their major campus. I also included in this map, as you can see, all these blue rectangles and squares, these darker blue ones. These represent the other Class A multifamily projects in downtown San Jose that have been recently built. And it was kind of fun putting this together because with all of these, these 12 projects that I'm including, Urban Catalyst partners, we've built 5 of them. So we obviously have tons of experience building multifamily here in the core of downtown. I personally built this one here, Meridian at Midtown, and Patina and Silver. My partner Paul built Delmas, and Spark, my partner Josh, built the Graduate. Here's what those projects look like. Pretty typical high quality multifamily residential, which is really needed here in downtown San Jose. Now on to this project specifically. So this is what investors are investing into with this fund. This is called Aquino. Aquino is a 272 unit multifamily apartment building. Also kind of interesting, our opportunity zone funds. We've got a senior living facility we're going to start construction on next year, right here on the same block, and we're already under construction on an 8-story hotel right across the street. I personally have built around 800 multifamily units on this street. So lots of experience in this neighborhood. We've had some very successful projects. This project, of course, at 8 stories, it's a 5 stories of wood frame over 3 stories of concrete, which is, it's really the typical, it's the typical building, construction code that is used in multifamily development here in Silicon Valley, really since they changed the building code to allow for 8 stories of wood frame in 2017. So then we see a lot of this 8-story multifamily around. Also, we have pretty traditional unit size and unit mix. So that means studios, ones and twos with a couple of 3 bedrooms. And also we already own the land for this project. We have all of the government approvals for this project. We're about halfway through the construction documentation process. We will be complete with and shovel ready by around April, and we anticipate starting construction in July of next year. Whenever we build multifamily, we like putting in pretty awesome amenity spaces for our tenants. So we have this really nice podium courtyard area, some outdoor dining here. Up on the rooftop lounge, pretty good views of the city. We also have a nice office space that we build in for our residents. And then finally, it's always fun to put in a speakeasy with a little hidden door. People love that on the tour, and they get pretty well used. So multifamily in San Jose, when I talk about it and kind of the demand for it, it's kind of a no-brainer. I mean, all of California, we have a housing crisis. And it's especially true here in Silicon Valley, where we've created 6 jobs for every housing unit that we've built for over 30 years straight. And of course, that leads us to having some of the highest housing costs in the country. In fact, San Jose was rated the most expensive big city to live in America and the 4th most expensive big city in the world. I'm just kind of just showing you some of those statistics here, but really the reason for this is supply and demand, right? We create so many jobs, we don't build units. In fact, we build less housing units than almost any other major metropolitan area in the country. The main culprit for that is we're surrounded by mountains and water. We don't have room to expand like other cities. You can think Dallas or Austin, they can just keep going horizontal. That is not the case here in Silicon Valley. Also, our local governments, they don't particularly like development, especially when it's all infill development. We have to tear things down to build new things. That means you have neighbors that are complaining and you have politicians that get voted in by the neighbors. So it makes it quite a challenge to get new units approved. What happens when you have this supply and demand imbalance? Well, we have the highest occupancy rates in the country as we just have nowhere to live. Kind of going along with that theme, from May to May of last year, we had the highest rental growth in the country. This continues, despite all the news you read about layoffs in Silicon Valley. What they don't say is we hired 10 times as many people during COVID than we've laid off in the last year and a half. So we still have so many folks here so many companies that need workers. It's kind of ridiculous. Also, a lot of third parties have come out and projected that the Bay Area and specifically the San Jose Metro region will have the highest rental growth over the next 5 and 10 years. This is a projection from Yardi Matrix. Kind of the same thought process. Supply and demand, job growth, Silicon Valley, not a lot of new construction. When we talk about the ability to do this IRA to Roth IRA conversion, it's a pretty attractive tax benefit. Just want to remind everyone that what really matters is the underlying real estate. So, understanding who the developers are that are building the projects, understanding the asset class and, the local market, that's what matters the most. A little bit about us as developers. I'm the founder and CEO. Been doing real estate development my entire career. I've done several $1 billion worth of projects, and in general, I build institutional quality and scale projects. That means I build big income producing buildings with a typical exit strategy of selling to a publicly traded REIT or a large institutional investment group. 5 partners here at Urban Catalyst. We've got about 40 people that work here now. My 5 partners, Josh and Paul, are my 2 development partners. Josh is my chief operating officer. Paul is my head of development and construction. I've known both these guys for over 15 years. I've been joint venture partners with them on the past when I worked at previous companies. Both experts in a variety of different asset classes and ground-up development with a lot of experience in Silicon Valley and San Jose. Paul manages our 18-person team of development and construction professionals that build all of our buildings here. Morgan Mackles, who's my really close friend for many, many years, almost 30 years now. We met in high school. He was a groomsman in my wedding. Always fun to work with your friends. He does all of our fundraising. He's why we've been so successful in our fundraising for the variety of funds that we have here on the Urban Catalyst platform. And then Sean Raft, Sean is our Chief Administrative Officer and General Counsel, so obviously he manages our legal teams, our financial consultants. He does all of our compliance with the SEC. Really easy way to say it, Sean really dots the I's and crosses the T's here at Urban Catalyst. So these are the 5 partners, and combined our experience, we've done a little under $5 billion worth of ground up development here in Silicon Valley. You can see the heavy concentration of projects in downtown San Jose. Now for the fun part, this is our project timeline. Some interesting aspects of this timeline, so I wanted to go through it with everyone. We're anticipating this will be a 1-year fundraise. So as soon as we stop fundraising, we'll start construction. Construction is supposed to last around 2 years or so. That's pretty typical for these 8-story buildings. We built a couple of them. Once we start construction, we'll go out and get this third-party report. Third-party report will show what our new valuation is. We anticipate it going low and staying low throughout the duration of construction. Why that's important is because it gives our investors the ability to do IRA to Roth IRA conversions over a number of years at this lower valuation. So you can do it in this example, 3 different calendar years. That means folks can adjust how much they want to convert in any calendar year, based upon their own personal tax situations. Once we finish construction, we have a year of lease up, and then we plan to sell the asset and return those funds to our investors, custodians and retirement accounts. And if they've done that IRA to Roth IRA conversion, all of that is tax-free. And of course, anything that they invest in the future through their Roth is tax-free. It's a nice thing about those Roths. And one of the things we like to say about this fund is, when you hear about California, people hear about our high tax rates, our politics, things like that. Not a lot of people are big fans of that. This fund in particular allows investment into California real estate, which historically has been, very successful over the last couple of decades. So you get access to California real estate without having to pay those California taxes. So we found that this fund specifically is very attractive to folks from out of state looking to invest into California real estate. Last thing I want to go over, in this fund, we do have a bonus units program, and this program has been very popular in our previous funds, so we did continue it into this fund. The way that it works is, if you invest into this fund, what you're doing is you're buying units. You're then paid out based upon the number of units that you own. We give bonus units in 3 different ways. The first is our time incentive credit. So we just launched this fund. We've had some pretty good success in the first couple months fundraising. Here we are in October, 5% bonus units. This would mean if you invested this month, you get, say you invest $100, you get $105 worth of our units. You can see it goes down every month throughout the fundraising process. This is really to reward investors for earlier investment. Next up, our multiple ventures program. This is for investors who have invested in our other funds. It's a loyalty rewards program. And then finally, our volume incentive program. I mentioned the minimum investment size is $50,000. At $200,000, that's when you hit the bonus units, and the volume incentive program goes all the way up to $1 million. Then we add these 3 columns together to get our total amount of bonus units. Also, one of the unique aspects of this fund, unlike some of our other funds when it comes to bonus units, is your bonus units don't come into play until we sell the asset. So you'll receive them upon sale. And why that's important is because we didn't want to mess with anybody's valuation when they do their IRA to Roth IRA conversion. So if they're choosing to do that, we're not messing with the valuation with bonus units. That happens at the end. So that was also a nice little aspect of our fund. Jimmy, that's the end of my presentation. I think we can open it up to questions now.
Yeah, tremendous, Erik. Well, that's my first time seeing that presentation. I've seen your OZ presentation a handful of times. Let's head to the questions here. Carl asks, hey, can you speak of the building's plans at the Aquino again with regard to earthquake protection? I'm sure it's a new building. I'm sure it's up to code. Talk to how you mitigate against the risk of earthquakes.
Yeah, so the Aquino project is very similar to the other projects that we've built. And really over the last, 10 to 15 years, the earthquake protections and structural systems have done nothing but become amazing. I asked my general contractor this exact question because we get this question a lot. Our general contractor says, our buildings are built to withstand about a 9 on the Richter scale, which is a really intense earthquake. We do not carry earthquake insurance, which is always the follow-up question to this question. Nobody does because it's cost prohibitive. In fact, usually what happens in an earthquake for our buildings, they don't like fall down, but like maybe there's some cracks in the walls or some of the windows will break. The deductibles associated with earthquake insurance are so large that it's cheaper for us to just fix the building after the earthquake occurs. And that's how every developer in California operates. No one has earthquake insurance.
Makes sense. Mitch wants to know, are you on the Schwab IRA custodial platform?
I'd have to check to see what platforms we're on. I know we're on like 10 platforms now. Schwab would be one that makes a lot of sense. Some platforms don't allow their investors with their self-directed IRAs to invest into real estate. So you do have to check with that. If somebody is on one of those platforms that is unable to make an investment into our fund, you can always switch platforms. We have a bunch of platforms that utilize that aspect of the investment of self-directed IRA into real estate. And I can send you a list and follow up on that question if you send me an email.
Very good. Other question coming in here. 1031 exchanges. Can you do a 1031 into this fund or any of your other funds at Urban Catalyst?
So this fund is not designed for 1031s. This fund is structured, just like a regular investment into, a real estate equity fund. We do have a specific fund set up on the Urban Catalyst platform for 1031 exchange investment. It is a Delaware statutory trust. We own a great industrial property in Dallas, Texas. If you want more information on our Delaware statutory trust and how it works from a 1031 exchange standpoint, I'm more than happy to contact you directly. We can go through how that fund works.
Good. Is this fund from Urban Catalyst only meant for retirement accounts? It's a big draw of it, or is it recommended for LPs and their taxable accounts as well? Does it really matter if you use a retirement account or not?
It really does not matter. We've found that a lot of our investors, they like our fund specifically because of the ability to do that IRA to Roth IRA conversion. As I mentioned, all of our funds that do ground up development, we have this lower valuation. This is just the first one we structured that allows retirement accounts to invest. But I'm sure throughout the course of raising this fund, we will have just regular folks investing because that has happened in all of our funds. So yes, you can invest just regular cash too.
Good. How does the IRA to Roth IRA conversion take place? Can you walk us through the mechanics of how that would actually happen if somebody wants to perform that and invest in your fund?
So that is very specific to every investor, what custodian that they use, how they've structured their accounts on their custodian. So that is something that I really can't walk you through because that is something that the investor is responsible for themselves.
Got it. Does your team help with that, or is that something that they would need
we do not help with that.
Or advisor on?
So usually what we tell our potential investors is if you're sophisticated, you've done things like this before, you're going to be fine because most custodians that allow direct investment into IRAs, you just contact your custodian and say, I want to invest. Then you contact your custodian and say, I want to do this conversion, and they can help you. Now, for folks that want a little bit more help, there are always, wealth advisors out there, both broker dealers and registered investment advisors, that this is what they do for a living as they help their clients do things like this. They do charge fees and commissions. So that's important to understand when you utilize those folks. You can also talk with your accountant or your attorney who are experts in these types of matters as to how to do it. But that's why I showed that slide, Jimmy, kind of saying, we have this great fund. It allows you to do this, but you have to realize that you have to do that aspect yourself.
Got it. Good to know. So make sure you get some good investment advice on how to perform that conversion from your CPA or attorney or other professional investment advisor. Blake wants, let's see, we've got about 2 more minutes here before our next presentation, Erik. So hold on tight. We got a couple more questions for you. They keep on rolling in. Blake wants to know, are the rules for Roth conversions changing in the next couple of years? Have you heard anything about that, Erik?
We're always hearing things about that, especially like the timing of when folks are required to take money out of their, IRA or their Roth, as well as, how much they have to take. But overall, I typically don't speculate on, future legislation when it comes to these types of things. A lot of folks, a lot of groups out there in the world, and a lot of people watch this really, really closely. So I guess what I can say is there's always changes. Most of them I'm seeing out there that are potential or kind of minor changes, not huge stuff.
Good. A really good comment here from Scott in the chat says, be careful with the conversion. It is really easy to screw up. And again, I would caution everybody, please do work with a CPA or an attorney to make sure you get that done right. You don't want to try to do it on your own. Last question, Erik, before I get you out of here. Let's see, we got a couple others coming in here. Okay, we'll get to two more questions. Does the total amount of conversion need to be done in 1 year or over multiple years?
Investors can kind of make that choice on their own, as will be under construction for 2 years, which spans 3 calendar years. They can choose if they want to do all their investment in year 1, year 2, or year 3, or all their conversion. They can also split it up into multiple years, different amounts in different years. It's really whatever benefits their tax situation the most.
Good. And final question, and then I'll let you get on with the rest of your day, Erik. 60 seconds, if you can keep it to 60 seconds on this one. Can you talk briefly about the current interest rates market and how that may be impacting your developments?
Sure. I mean, obviously, developers across the country are pretty impacted by interest rates because most developers utilize senior debt when we build our buildings. Interest rates for the last 10 years have been at 3%. Now they're probably closer to 7 to 9%. We're not seeing as much development occurring across the country or here in Silicon Valley. This project in particular, it's got some really good fundamentals, including land value, what we paid for the land, how market rate rents have gone over the last couple of years. So this project, even with those higher interest rates, we're going to be able to start it. And then we don't worry about a refinance event for this project because we anticipate selling at the end of stabilization.
Very good. Erik, we're at time. Thank you again to you and Urban Catalyst and your whole team over there, our title sponsor for today's event. Thank you so much for your ongoing support with both Opportunity DB and WealthChannel. You're going to present. You're also our title partner at our OZ Pitch Day on November 9th, which will be all focused on Opportunity Zone deals. If anybody in the audience wants to learn more about that event, you can do so by heading to ozpitchday.com. That event will be focused 100% on opportunity zones. And again, Urban Catalyst will be our title sponsor for that event. Looking forward to that one on November 9th, coming up in just a few more weeks here. Erik, with that, I'm going to let you go. Thank you so much for joining us today. Really appreciate your time.
Hey, thank you, Jimmy. Always a pleasure.